Come along with us as we dig into the ins and outs of globalization. By taking a close look at the Asian financial crisis, we're going to explore how globalization played a role in this crisis. From the emergence of new markets to the tangled web of interconnected finance, it's like peeling back the layers of a really big onion to reveal how the world works under the influence of global forces. So, let's dive in and unravel the mysteries together. What was the Asian financial crisis? The Asian financial crisis, also called the Asian contagion, was a sequence of currency devaluations and other events that began in July 1997 and spread across Asia. The crisis started in Thailand when the government ended the local currency's de facto peg to the US dollar, after depleting much of the country's foreign exchange reserves, trying to defend it against months of speculative pressure. Other economies also came under pressure, but those with solid economic fundamentals and hefty foreign exchange reserves fared much better. Hong Kong fended off several major but unsuccessful speculative attacks on its currency, which is pegged to the US dollar via currency board system and backed by massive US dollar reserves. As the Thai baht fell, other Asian currencies fell some precipitously. Across Asia, inflows of capital slowed or reversed. The Thai baht had been trading at about 26 to the US dollar before the crisis, but lost half its value by the end of 1997, falling to 53 to the dollar by January 1998. The South Korean won fell from about 900 to the dollar to 1695 by the end of 1997. The Indonesian rupiah, which had been trading at around 2,400 to the dollar in June 1997, plummeted to 14,900 by June 1998, less than 1/6 its pre-crisis level. Some of the more heavily affected countries fell into severe recession. Indonesia's gross domestic product, or what we call GDP growth, fell from 4.7% in 1997 to -13.1% in 1998. In the Philippines, it slid from 5.2% to -0.5% over the same period. Malaysia's GDP growth similarly slid from 7.3% in 1997 to -7.4% in 1998, while South Korea's contracted from 6.2% to -5.1%. In Indonesia, the ensuing economic crisis led to the collapse of the 3-decade-old dictatorship of President Suharto. The International Monetary Fund, or IMF, and the World Bank, among others, stepped in to help during the crisis. They provided around $118 billion to Thailand, Indonesia, and South Korea to rescue their economies. The Asian financial crisis had a significant impact on GDP. To receive assistance from the IMF, affected countries had to make changes to their economies. These changes varied from country to country, but typically involved improving financial systems, reducing debt, increasing interest rates to stabilize currencies, and cutting government spending. The crisis also serves as a valuable case study for economists to understand how interwoven markets affect one another, especially as it relates to currency trading and national accounts management. What were the primary factors that triggered the Asian financial crisis? The crisis started because of certain government policies and investment trends. When the crisis hit, markets reacted strongly, and one currency after another came under pressure. Problems like high foreign debt, big budget deficits, and too much lending by banks all contributed. Before the crisis, governments focused on boosting exports by helping businesses and keeping the currency's value low. This helped exports, but also had risks. Governments promised to rescue struggling businesses and banks, which made investors more interested in political support than profits. There were also cozy relationships between local businesses, banks, and regulators. Lots of foreign money came in without much thought about risks, leading to risky investments. As the crisis spread, It showed that the high economic growth rates in these countries were hiding serious problems. There was a lot of borrowing, especially for risky projects. Real estate prices went up fast, fueled by easy credit. Countries also borrowed a lot from other countries, often for short periods, which made them vulnerable when their currency's value dropped. Many Asian countries ended up with more money going out than coming in. This meant they were borrowing more from the world than they were lending. This happened because governments spent a lot to keep exports growing. What was the response to the Asian financial crisis? The IMF stepped in to help stop the crisis by lending money to stabilize the affected economies. They, along with others, lent about $118 billion in short-term loans to Thailand, Indonesia, and South Korea. But there were conditions for these loans. Governments had to increase taxes, reduce spending, and cut many subsidies. By 1999, many of the countries hit by the crisis were starting to recover. Other financial institutions became engaged in addressing the crisis. For example, in December 1997, the U.S. Federal Reserve Bank facilitated an agreement wherein United States banks owed funds by South Korean companies on short-term loans, consented to prolong them into medium-term loans. Lessons from the Asian financial crisis. Many of the lessons of the Asian financial crisis remain relevant today. First, beware of asset bubbles, as they have a habit of bursting. What is a bubble? A bubble is an economic cycle that is characterized by the rapid escalation of market value, particularly in the price of assets. This fast inflation is followed by a quick decrease in value, or a contraction, that is sometimes referred to as a crash or a bubble burst. Another lesson is that governments need to control spending and pursue prudent economic development policies. How do government spending and monetary policy affect a currency's value? When governments spend, implement policies that keep taxes low, subsidize the price of staple goods, or use other methods that effectively put more money in people's pockets. Consumers have more money to spend, as most economies rely at least partly on imports for many goods and services. This increased spending creates demand for foreign currency, usually US dollars, as importers have to sell local currency and buy foreign currency to pay for imports. Demand for foreign currency increases exponentially when those policies also promote heavy investment in infrastructure, new businesses, and other economic projects. As more local currency is offered for sale on foreign exchange markets, its value goes down, unless there is a corresponding demand to buy it. Why do governments keep exchange rates high? Governments, especially in developing economies, seek to manage exchange rates to balance their ability to pay debts denominated in foreign currencies, because investors generally prefer instruments denominated in more stable currencies. Governments in developing economies often raise funds by issuing bonds denominated in US dollars, Japanese yen, or euros. However, if the value of the domestic currency falls versus the currency in which its debt is denominated, that effectively increases the debt as more local currency is needed to pay it. So, when the Thai baht lost half of its value in 1997, that meant local borrowers needed twice as many bahts to pay debts denominated in US dollars. As many developing countries also rely on imports, a higher valued local currency also makes those imports cheaper in local currency terms. Why do governments keep exchange rates low? On the contrary, governments may seek to keep their exchange rates low to increase the competitiveness of exports. In the 1980s, following years of complaints from U.S. companies about competition from cheap Japanese imports, the U.S. government convinced Japan to allow its currency to appreciate as part of the Plaza Accord. The currency's value climbed from 250 yen to $1 in early 1985 to less than 130 yen by 1990. The U.S. trade deficit with Japan fell from $55 billion in 1986 to $41 billion in 1990. The bottom line: Asian financial crisis serves as a reminder of the importance of prudent financial management and the risks of excessive reliance on foreign investment and debt. It also underscores the interconnectedness of global markets and the need for coordinated responses to economic challenges. As we move forward, it's essential to learn from the lessons of the past and work towards building more resilient and sustainable economies. By doing so, we can help ensure a brighter and more stable future for generations to come. Thank you for joining us on this journey of exploration and reflection.